Well, it's safe to say that the M&A frenzy continues at pace, and despite the carnage in global supply chains, rising inflation and a scarcity of talent, most observers are confidently predicting that this bull market has life in it yet. Renowned bellwether Sir Martin Sorrell expects a correction in 2023, especially for companies with more traditional business models. But he's betting that digital and tech-enabled companies will continue to grow, albeit perhaps at a slower pace. And that view is clearly expressed in S4 Capital's ongoing acquisition spree. There's no shortage of motivated buyers and sellers in the market, but a growing problem for deal makers is that, not unlike elsewhere in the economy, the infrastructure that supports M&A is starting to creak under the strain of intense demand. Global M&A fees for the first 9 months of 2021 exceeded $100 billion, the highest level ever recorded. Little wonder then that the accountants, lawyers and regulatory authorities required to get deals done are struggling to cope with the workload, and some deals are taking a little longer than people would like. Private equity continues to provide most of the fuel for the current heat in the market, both through platform investments and subsequent buy and build strategies. The epicentre of demand is for tech and tech-enabled companies that demonstrate the ability to grow faster, more profitably and more sustainably than purely talent-based companies that sell ideas and time. This is where the real premiums, the revenue multiples and the bidding wars are to be found. But we're still seeing plenty of demand for a wide range of agencies and consultancies that have a highly differentiated or specialised offer, contemporary client base, and the strong revenue growth that tends to result from those two key attributes. As to how deals are being structured, well, the trend towards faster integration continues, and that means that earn-outs are getting shorter. With longer deals, it's relatively easy to offer a high headline multiple. The buyer just makes realization of the full price contingent on delivering growth over 3, 4, even 5 years. But in a market where sellers can command a premium, the implication of shorter deals is that buyers are taking on more risk by paying the full value over a shorter time period. So listed and PE-backed buyers are often paying a portion of the value in equity, keeping founders locked in and incentivized over the longer term to offset some of this risk. All very sensible, but for that to work, you need a convincing equity story. Buyers that have too much of the future value growth baked into their current share price will find that sellers place little value on illiquid stock with no obvious upside and over which they have no control. Overall, sellers seem pretty willing to transact, perhaps sensing that the next opportunity might not be for several years and could be in a very different tax environment, especially in the UK and the US. So expect deal announcements to come thick and fast over the next few months.